Hello there, this is James, and you're watching the latest episode of our Primus Live webinar series. Now, before I introduce you to my very special co-host, remember, these little episodes are for educational purposes only, and in no way whatsoever should be taken as advice. I always suggest you do your own research and do your own due diligence, and of course, know the risks at hand before entering any trade. With that out of the way, let me give you a brief introduction to my very special co-host. Her name is Kaia, and she is our head of investment research here at FXPRIMUS. Now, she's worked as a portfolio and investment manager with access to both public and private markets. Now, before FXPRIMUS was lucky to get her, she was a senior investment associate at a hedge fund in Singapore and a vice president for Bank of America, Merrill Lynch. Welcome, Kaia.
Hi, James. Thank you for having me. How are you today?
I'm very, very good. And by the way, the pleasure is always mine. I'm very well, thank you. How are you doing today, my darling? How's things?
I'm doing great. I'm very excited about our topic today, and also very excited to go through the market update because we've had pretty eventful couple of weeks.
We really have, haven't we? And obviously, this is, like I said, we're doing a 2-weekly show now, so there's quite a fair bit which happened in the market since we went on last time. And both of us are back in the office, which is brilliant news. So let's start off with what's been going on, what we missed or not missed in the markets.
So on the macro side, I would say the biggest update that is 1.9 trillion stimulus package was finally approved. So this is officially now going out. We have seen a bit of rotation trade happening in the US, meaning we've seen a bit of capital outflows from equities. We've seen more capital inflows into defensive sectors of equities, I should say. We have seen interest rates getting higher, and I mean the Treasury yield curve. And also we've seen a bit of a pop in oil price.
Oil in particular has been taking a lot of headlines over the sort of last couple of trading sessions in particular, both obviously Brent and obviously WTI. So there is optimism obviously in the energy market. Do you see it continuing as it stands at the moment, or do you? What's your appraisal of that?
I think oil and commodities in general are a very good indicator where investors see the economic growth going. So for me, I use a couple of sort of commodity, not to say indices, but just commodities to see how investors are pricing in the future growth. One of them being clearly US oil, so WTI. But I also like to use a index called CRB, which effectively is a sort of blended mix of different commodities, but agriculture and energy have the biggest weight. So both of these are, not to say all-time high, but they are at swing highs, and definitely showing that investors see a bit of a growth happening in the short and medium term. And oil, of course, always being sensitive to all sorts of geopolitical events, which we saw also on Sunday with the world's largest terminal being attacked in Saudi Arabia once again, which gave a bit of a pop to oil price. But also the OPEC meeting that happened last week. So OPEC Plus decided to keep production the same, which was a bit of a surprise for the markets because everybody expected them to increase production. And oil was up 7.7% last week, which is pretty significant gain, I would say.
Absolutely. I mean, like I say, it has been on a very, very big run. And I'm looking at it on my chart on a daily. You can really see it start to. This is WTI I'm talking about. I can see you starting to move round about the end of October, just before obviously the magical 9th of November day when the market got really optimistic, which we covered obviously in previous episodes. So it's been on a bit of a run since then.
Yes, agreed.
So it's yeah, like I say, again, obviously winter is coming to an end as well. And so obviously heating and issues and things like that. I know we'll really talk about heating oil with that in particular, but obviously oil comes in the impact with that. And there is optimism in the market that things are getting better. Like you said, the stimulus package has also been approved. So things are looking a little bit more rosier than they were several months ago. So really, do you think really we can maybe continue to see this little bit of a bull run on oil continuing for maybe not just the medium or short term, but maybe in the long term too?
I think my personal view is when it comes to commodities, it's hard to predict the long run because, again, oil, and oil in particular, because it's exposed to so many geopolitical events as well. Like, for instance, now US having discussions with Iran again, we could see more supply on the market, which might bring oil price down. But at the same time, for oil, there's always a big push from certain key economies. And China picking up growth really fast last year. It was the only large economy that had positive growth last year. And these projected to grow officially more than 6%. But analysts are expecting around 8% growth. And definitely there's a lot of demand for oil in China because they don't have their own supply. They will have to import. So keeping an eye on China, I think, will be key also to draft a bit of a trend for oil going forward.
Yeah, totally agree. What else has been happening other than the energy market?
What else has been happening? So I will just mention that commodities are high as well in general. Let's just call them a very broad sort of bracket of commodities. So that puts a pressure on certain companies that use commodities as their raw material. And specifically, these could be consumer staples, for instance, but also capital goods or industrials. So two ETFs that I would suggest keeping an eye on. One of them is XLI, which is industrial ETF. And companies in that ETF have more than 40% cost of goods coming from commodities. So definitely a lot of impact. And the other one would be XLP, which is consumer staple. So these are your toothpastes and I don't know, hair gel and, very basic things. But I think at this point, labor market is still so weak that the companies struggle with passing on the increased cost to consumers. And therefore, they may choose to absorb that cost in order to protect their market share. And therefore, the bottom line, the net income, most likely will become under pressure should we see the bull run continue in commodities markets.
Of course, the one commodity which hasn't been doing so well, which is obviously one of my favorites, which is gold. Obviously, that's been under it's been under pressure certainly over the last couple of trading sessions, hasn't it? But it's making a bit of a bounce back, but.
So I think gold is now 9-month low, right? So, there was an interesting piece of research I read the other day, which was coming from Rosenberg Research. And they do project that it's about $200 per ounce that gold has lost because of Bitcoin being in existence now. So young millennials do choose digital gold over physical gold. And therefore, your favorite is a bit under pressure for the time being.
Yeah. But what do they know? What do these youngsters know? Exactly. Yeah, that is true. I mean, yes. Bitcoin.
Bitcoin, yeah. So what else is happening? Something we discussed already 2 weeks ago was the US yield curve sort of taking a bit of a step higher. And a movement we have seen is in technical terms called the bull steepener, although it has been between bear steepener and bull steepener. And the difference is whether we see short-term interest rates picking up or it's a long-term rates picking up. As of today, I'm just going to open my charts in parallel to see what's happening. We are seeing a bit of actually flattening today. Anyway, I don't have that chart in front of me. I'm going to put 10-year yield here. But point being is that the higher the interest rates on the long run, in the long end of the yield curve, the more pressure we're going to see on those companies that have cash flows very far in the future. And that is the basic net present value calculation that those in finance field would know about. At the same time, higher interest rates should also mean that we're going to have higher economic growth in the future. So I do believe at some point those growth stocks are going to recover. And that's something we saw yesterday with, Tesla being up. I can't remember how many, was it 20%, 19.3%?
Around that sort of figure, wasn't it? It did perform very well, yeah.
Yeah, and NASDAQ had a very nice pop as well. So I think the market is a bit of unsure how we're going to price the growth stocks, those very long duration stocks. And I think the market is a bit unsure whether the yield pickup has been because of higher inflation expectation or actually higher growth expectation. These two don't sort of mutually exclude each other, but at the same time, if we have just high inflation expectation but low growth, this is something we call stagflation, and definitely not good for stocks.
Absolutely. We had the US CPI today, didn't we, as well?
We had US CPI slightly below expectations. I believe year on year was 1.3% versus expectation of 1.4%. And month on month was 0.1 versus 0.2. And talking about core CPI, which excludes food and energy. I haven't had time to go into the details because the number is released maybe less than 45 minutes ago. But more than interested to see where actually the components, what was contributing and what wasn't. But again, we have talked about CPI before. More than 30% of CPI actually comes from shelter, effectively being rent. And we have seen a lot of forbearance when it comes to different, not just rentals, but also mortgages. So until the employment situation improves in the US, it's again hard to see how CPI can be higher than expected.
Exactly. Even like I said, we had a quite an impressive NFP obviously on Friday. But again, that's one of those figures which is obviously can be, I don't want to use the word manipulated, but it's one of those figures which, if you often notice, it often changes or revised obviously every month. So that had a bit of a shock to the market, but it wasn't an overall massive shock for.
It wasn't,
No, it was
because with the NFP. Nice. I think it was 379,000 jobs added versus expectation 100 and something. And also the previous month number was revised from plus 49,000 to plus 166,000 jobs. But James, very important data point. Not sure if you picked that up, but if you actually saw that, it was sort of hidden in the message, I would say. 96% of the recovery came from 3 sectors. So it was leisure, hospitality, it was health, and it was retail. Sorry, it was 4 actually. So point being, these are not your highly skilled, high-paid jobs. Unfortunately, these are the low-skilled and in terms of value add to the economy at the bottom of the hierarchy. And not to mean any disrespect, because they are definitely needed jobs. But at the same time, when we talk about economic growth, you want to see jobs added in the sectors where you have the highest pay.
And as well as that, the most of the sectors you mentioned, hospitality, leisure, and retail.
Retail were the three main
retail.
ones.
Not be funny. That's only because it also makes a lot of sense why those sort of sectors in particular have dropped, because obviously bit by bit things are trying to get back to normal after obviously the lockdowns from last year, etc. So again, those are the industries which we would expect by now would be increasing in jobs. Bear in mind they've been laying dormant for quite a while due to obviously the COVID-19 crisis. So again,
they shed the most jobs, so of course they're going to sort of bounce back faster.
Exactly.
Yeah, and a few other things on the jobs report. Maybe we mentioned the last time, but female labor force participation, 33-year low, at 55% right now. So that's a huge drop. So more than half of the jobs lost back last year were among female population, and less than half recovered have been among females. So until we get the sort of economic reopening to the place where women can return to the workforce, it's hard to see again where the inflation is going to come, because we have such a huge gap in labor force supply.
Yeah, definitely. Anything else you want to look at or discuss on that?
Let me just browse my notes really fast, because I mean, from the data front, it's been pretty intense week, I would say. A lot to dissect, and a lot of the message, I think, sort of gets hidden. One more important thing: the interview that Jay Powell gave last week to the Wall Street Journal, I believe. Something he mentioned around how full employment would be measured going forward. So until this point, take a step back, Fed has dual mandate to make sure the price level in the economy is stable. So that would be your inflation, CPI. And secondly, to ensure full employment. Full employment generally is just being gauged using that unemployment number. So at this point, we're sitting at 6.2. However, Jay Powell realizes now, the Fed realizes now that that's not the only important data point. We also have to look at labor force participation rates. How many people actually do want to look for a job? Because if you're unmotivated person, means that you're not even considered as unemployed because you've just given up. And also they want to look at the unemployment rate among minorities. So that would be a Black community in the US, and also the same female population, which is very important. So full employment would not be achieved until unemployment rate is low enough among all the sectors of the population, and also the wage growth has picked up. So just something to keep an eye on as well, not just the employment number, but also the sort of the details. The proof is in the pudding, as they say.
The proof is in the pudding, as I often say. So not just the number, but also the areas where the job growth is happening in the different minority groups or different groups in total. So fun times ahead, indeed.
Fun times ahead.
Don't you love this job? Don't you love the market?
Yes, I love the markets. I love the markets.
It is. Yeah. Who wouldn't? Who would not love the markets? I love this job. Right, should we move on to a bit of our topic of the day?
Let's cover the topic of our day, because this is, again, super interesting topic and coming from our viewers who have asked about correlation. And James, I'm going to hand over to you, because I know this topic is, I shall call it your baby. So
I know, maybe like a stepson, maybe, or stepdaughter. It is, currency correlation is something I do pay a lot of attention to when I'm trading, because I think it's very important. And I'll go through some of the steps why I think it's important to know. First off, of course, the big question: what am I talking about? What is currency correlation? Now, currency correlation is obviously a statistical measure of how two currency pairs. Don't forget, currency, when it comes to Forex, currencies are traded in pairs. How two pairs move in relation to each other. So when it comes to sort of like currency correlation, they can be like several aspects. To be neutral when there's no relationship to them. But the two we really want to pay attention to is whether or not they're positively correlated, which means the two pairs or two separate pairs may potentially move in the same direction, or the negative correlation pairs. That means two pairs are negatively correlated, which means they will potentially move in the opposite direction of each other. And this is all during a period of time. Now, again, we've had, remember one of our favorite topics was risk management. Do you remember that? We went on that, and we talked about the trader's diary and all this and all that. I'm very, very big on that. But reason why I like currency correlation in particular is it can, understanding it can control your risk exposure. So again, it goes down to sort of risk management. If our producer kindly go on to the next slide, have a little bit right now. Let's see if I can say this, because you know what I'm like. We're getting my words out. Now, the next thing you need to know when it comes to currency correlations is what's known as correlation coefficient or coefficiency. Okay. Now, currency correlation is actually calculated, okay, by what's known as this word, currency coefficiency. Now, coefficiency actually ranges between -1 and +1. What does that mean? Well, let me break it down. Okay. Now, the perfect positive correlation is that the closer a currency pair's coefficiency gets to +1, the closer those two pairs are positively correlated and may move in the same direction. The perfect negative correlation is that the closer the two pairs coefficiency gets to -1, the two pairs will potentially move in the opposite direction. Now, as you can see from my little line there, obviously the little illustration I've done, closer to 0, 0 is weak correlation. Closer to -1, strong negatively correlated. Closer to +2, strong positive correlated. Okay.
I have an example I want to share about positive correlation. So those in our FXPRIMUS office, there's a very strong positive correlation between James wearing her handkerchief and having Primus live. I would say the correlation is +1.
Exactly, it's very +1. Though, you know, you had to go at me the other day for not wearing a tie, so I had to sort of dress it up a little bit. One day I'm going to come in with a monocle and a top hat and see if you notice. Yeah,
hard not to notice, I would say.
Well, you love it. It's a nice shade of red. It goes with the blue. It brings out the color of my
I think
eyes.
it looks perfect. Yeah.
There you go. Bloodshot. You see what I mean? If we go on to the next slide, Mike, please, buddy. I want to show you what traders look at. Okay, and this is what's known as a currency coefficiency table. So you can find it obviously online if you Google it. It makes sense to check it on a daily basis if you're looking at currency correlation, because it gives you a lot of information on whether or not a currency pair is close to being negatively correlated or positively correlated. Now, as this example, you can see we have the Aussie dollar, Euro Swiss, Euro Sterling, Euro Yen, Euro Dollar, etc. across the top, and then you have the same pairs across. So again, it's like the old-fashioned times table you used to have, you used to do maths. So if you compare, say, for example, the Euro Swiss to the Aussie dollar US dollar, their number is 0.4186. Pretty, not quite close to 1. So it's not positively correlated. However, you look at the Euro Swiss across the board compared to the Euro Yen, it has that number there is 0.7703, which means it's slightly stronger towards being positively correlated. And if you go all the way down to the end, where you got gold there, my favorite, is minus 0.4777, which means it's negatively correlated, but it's not close enough to -1 to say that it's not overly negatively correlated. However, then, if you go down on the table, when you see the dollar Swiss, and you look at how it's looked at with the gold dollar, again, you have the number minus 0.7826. Again, getting closer to that all-important -1, which means potentially it's very strong negatively correlated. And my suggestion is, and this is what I often do when I'm trading currency pairs, is I'll talk about the particular thing I do at the moment. I always look at the table quite closely to see how closely a pair is either positively correlated or negatively correlated, because things do, surprisingly, this is the market we're talking about, does indeed change. So this is where we always need to be aware of it. And a lot of it does sort of tend to make sense as well when you're looking at positive and negatively correlated. If I give you a prime example, if you look at the guppy, which I'll talk a little bit more about in a minute, British pound, Japanese yen, if you compare it to the British pound, US dollar, you can see it's 0.7896 positive, which means again, it's close to that +1, which means it's positively correlated. That makes sense because stronger cable or stronger sterling will affect the sterling strength against the dollar and obviously against the sterling yen. So all of this sort of makes sense. Go into a little bit more. If we go on to the next slide, please, Mike. The reason why I stress, and I said this at the very beginning, stress how important understanding currency correlations is if you're trading multiple currency pairs, you always need to be aware of your risk exposure. Again, I'm very big on risk exposure. We had that brilliant live episode a couple of months back where we talked about trading diaries and risk exposure, really big into risk exposure. And I think if you understand currency correlations or aware of it, it helps you with your exposure. So say if I give you an example, if you trade, say the Aussie dollar, US dollar, and you've got at the same time, you think you're spreading your risk and you go, I tell you what, I'm going to open the Kiwi, the New Zealand dollar, US dollar at the same time, so I'm not putting all my eggs in one basket, so to speak, but technically you are, because both the Aussie dollar, US dollar and the Kiwi are both commodity-based currencies, as we discussed in the past, and they're very closely positively correlated. So if you are losing on the Aussie dollar, US dollar trade, to try and hedge yourself or try and open a separate trade and limit your exposure, opening a Kiwi trade, you're doubling up technically or potentially on your risk because they're positively correlated. So you're not actually doing yourself any favors. So if you've got a losing position on one pair which is positively correlated with another, it might be a good idea to understand that's the case and not open up a position on another pair which is going to likely move in the same direction as that one, because then of course your account is at greater risk. And at the same time, this is how I personally use currency correlations, is I use it for hedging options, potentially hedging options. Not that I say, again, this is not trading advice, for example. It's definitely not trading advice. Of course not. It's just education. But for a prime example, when I do one of my trades I tend to do, I do a lot of the euro sterling trade. Okay. And I do my analysis on the euro sterling trade. And what I look at, and I look at the correlation table, and the one of the strongest negatively correlated currency pair to the euro sterling is the guppy, which is the British pound, Japanese yen. They're very strongly negatively correlated. I don't know. Do we have a chance? Can we bring up one of your charts? Can we have a look at it on your?
Which one do you want to look at first?
If we could bring up, say, the euro sterling first, if you don't mind.
Sure. Euro GBP open on mine, and I am sharing my screen as well.
Perfect.
So I believe our production manager should be able to see this now.
Perfect, perfect.
So we are looking at the daily chart, just letting you know.
So this is perfect. This is exactly what I want to see. So if you have a look at the daily here, so this is the euro sterling. Okay, so obviously we can see it's been under pressure. Quite a few trading sessions is on a negative, negative downtrend at the moment. So obviously, because the sterling in particular has been outperforming or overperforming beyond expectations. So as you can see, it's moving in a downward projection. If we can then bring up the guppy, for example, on a daily as well.
GBP, JPY.
There you go. It's going in the opposite direction. Okay, because obviously this sort of makes sense. If the sterling is getting stronger against the euro, okay, then it's based on sterling's strength. Okay, so then the euro sterling will likely to fall because you've got stronger sterling, which also means the sterling will get stronger potentially against the Japanese yen, hence going in the opposite direction. Now, again, this is not trading advice whatsoever, but what I tend to do is I do my analysis on the euro sterling, see what levels of interest I'm looking at, place a trade on the euro sterling, and then to protect myself, to hedge my position, I will say, for example, go long on the euro sterling. If I believe the euro sterling was going up, I would say open up a slightly larger contract size. And to hedge myself, I would also go in the same direction, okay, same direction as the euro sterling, but a smaller contract size, with the idea that if I'm wrong and I lose on the euro sterling, the guppy will make up some profit back, so I do not lose everything. Now, obviously, people say, well, it's not negative correlated. Why are you going the opposite directions? Purely, like I say, it's for a hedge. If I'm going long on one and I'm wrong, clearly the euro yen will also rise, which means we'll cover myself now, or cover some of my position there. It's not always perfect. I stress this. It is not a perfect trade. It doesn't always work, but it's something I tend to use, and this is why I think it's always important to know currency correlations in this way. If we could have maybe a quick look at the dollar Swiss, another example.
USD CHF coming up. Oops,
okay, this is on a.
Let me just remove some stuff here.
No problem. This is on the daily, a daily again, yeah.
This is on a daily, correct?
Okay, brilliant. Because I like daily. So again, as we can see, the projection there pretty much is like I say, it's been fairly bullish over the last couple of trading sessions. But then if we have a look, say at the euro dollar at the same time, bring the euro dollar up.
Euro USD.
There we go. We can see not quite as dramatic as the euro sterling and the guppy is, but we can also see that obviously the euro dollar over the last couple of sessions has struggled a little bit against it. So again, these are two pairs which can be quite strongly negatively correlated. So again, what I tend to do if I'm looking at the euro dollar, looking for an opportunity, maybe put my main trade on the euro dollar, but then maybe just cover myself a little bit on the dollar Swiss to make sure I don't get wiped out completely. Again, like I say, not trading advice, and it doesn't always work. But at the same time, this is why I'm a big believer in currency correlations.
Yeah, and Euro USD traders, keep an eye on this 200-day moving average here that we are approaching, I would say, quite fast. Definitely an area of interest. I just wanted to share a couple of sort of comments on everything you've said. So first of all, with correlations, it's really important to keep in mind that they do change in time. So these are not like static numbers. They change in time, meaning most likely after Brexit, we're going to see a bit of change in correlation, let's say Euro GBP pair and in general, because the two economies are much more detached going forward. Also, correlations tend to go bananas whenever we have a trouble in the markets. So let's say during last March event, all correlations were completely haywire. Those strategies that had used correlations in order to hedge, let's say, the parity funds, for instance, it did not work because all correlations were basically nearing 1. Also, I would point out that correlations do exist not just among currencies, but also among different asset classes. So they generally tends to be inverse correlation between US dollar and gold, for instance. The higher the gold, the higher US dollar, the weaker is gold. But these also change with time. And, commodities is an interesting sector because commodities have become so monetized that the correlation aspect with US dollar is basically gone. So most of commodities trades are not done with physical anymore. They're done with derivatives. So that the correlation that was, present before is almost non-existent.
Non-existent. Actually, that reminds me actually of a time, and you're absolutely right. And we, must stress correlations are not set in stone. They change on a daily, maybe 30, even on a short term, even shorter than a day basis. This is why it's always important to check the currency correlation table and things like that. But to bring up to highlight your point you made, I remember years ago, because don't forget I'm really old and I'm really ancient. I remember back in the day when I was trading gold, there was a strong correlation between gold and WTI. This is back talking 2000, 2008. I remember, and there was a very strong correlation between those two. If gold moved higher, oil moved higher. They were like best buds, best friends. And I remember there was times, for example, I was a gold trader. We would go in to watch the sort of hurricane in the Gulf of Mexico to see how many oil rigs were damaged, not to buy oil, but to jump in on gold. That's what we were looking to do because they were so positively correlated. That is totally gone out the window now. There is no correlation between those two assets anymore. So underline your point, these things do change, and they like I say, they have a short-term, very close relationship, but then sometimes that relationship breaks down and is non-existent.
Yeah, and there could also exist a phenomenon called spurious correlation, which means like statistically there is correlation, but there's absolutely no logic behind that correlation. Like for instance, if you see, I don't know, snowing outside, and then you see yellow snow, like there's no correlation between these two events, yet they happen at the same time, if you know what I mean.
I know what you mean. Yes.
and to give a bit of like technical understanding behind what does correlation coefficient mean? Like people think that it's let's say if euro moves in one direction and the correlation is 0.72 likelihood, the underlying is going to move the same direction. No, that's not what it means. It means that the change in one currency can be explained by 0.72 by the change in the other variable. So that's what correlation coefficient means. It doesn't mean the likelihood of if one changes, then the other one changes as well. It's just how much you can explain by the other pair or the other underlying.
Yeah, absolutely. I mean, like I say, you could have, people often see the cable can be close to positive correlated with the euro dollar. So if you've seen the euro dollar sort of moving higher, then many people straight away look towards the cable to do the same. And sometimes that does happen. And that's usually down to the fact that you have dollar weakness across the board. But other times the euro dollar could be performing well because you have got dollar weakness. However, the cable might not, or the sterling might not be performing as well, because though we have still got dollar weakness, there's worse news happening in the UK, which is holding back the sterling. So again, like I say, it's not a foolproof plan. It's not always 100% on the money, so to speak, but it's still something I think, lot of people should take into consideration when looking at their trading strategy, definitely.
But I think it's brilliant that you bring up the hedging aspect as well, and the fact people would question like, oh, but why would you hedge with a negatively correlated pair? The point is not to offset these two positions. You don't want to have, full position in your hedge as well. You just want to have a part of it, like at least portion of it. And because you're going to have your stop loss anyway, you're not going to allow the position to go into zero, right? So, and similar thing, like for instance, if somebody would buy US equities, for instance, they want to have long position in, I don't know, Tesla and whatever, you may want to buy a put option on S&P 500, which will protect you from the downside risk. So it's similar.
Yeah, exactly. It's basically in one way or another. So options in particular, it's like taking an insurance policy out on a position. That's all you're doing. You're just taking out for the worst case scenario that you're covering some of your exposure. That's all. That's basically what you're doing.
And you don't want to have the full sort of capital outlay for the hedge position. You want to put as little capital as possible while making sure you protect as much as you can. Exactly.
Safety first, as my mum always used to say. Okay, that's our currency correlations. I'm not quite sure we have any questions at the moment, but we're planning to do another show in 2 weeks' time. Is that right?
We're planning to do another show in 2 weeks' time, and we are getting a lot of requests to do the show on cryptocurrencies. So, James, I have a feeling you have to push up your skills and your knowledge, and we have to talk about crypto, and we have to talk about Bitcoin.
Well, if the people want it, we will deliver. Let's
do a quick poll. Let's see. Maybe Mike can help me with that. Mike, everybody who wants to hear about crypto in 2 weeks, can we please get a thumbs up on right now? How many likes are we gonna get? 0?
Please. No, I'm only joking. Okay, so we do it on cryptos and
we'll do it on crypto.
Yeah. Okay, that's fair enough.
And again, I would propose doing it from the perspective of market structure, and again, maybe drawing a bit of a comparison with gold, because gold is something that it does get a lot of attention, and it's traded a lot, not just on our platform, but in general. Gold is one of the most traded assets. So we'll do a bit of a comparison, let's say crypto versus gold, stable coin versus the rest of the coins.
No, like I say, well, look, at the end of the day, this Bitcoin is very much in the news, obviously, because it is a very exciting asset for many. And it is a very popular asset to be traded, as we know. It does create a lot of volatility in the market. So yes, let's talk about cryptos. We'll do it on that by all means. Why not? I haven't spoken about it for ages, so yeah, why not? Why shouldn't I talk about it?
Lovely. Looking forward to it.
So in 2 weeks, cryptocurrencies, ladies and gentlemen. Cryptocurrencies. Right. I don't think we have any questions for now. So let's sign off. Kaia, do you want to say goodbye to the good people?
Thank you everyone for joining. Thank you for submitting your ideas. Thank you for submitting your questions, and looking forward to seeing you in 2 weeks.
Perfect. Again, as Kaia said, thank you so much for your interaction and for joining us today. Without you, we have no show. Now, remember, as always, these little live streams are for educational purposes only, and in no way whatsoever should be taken as advice. I always suggest you do your own research and do your own due diligence, and of course, know the risks at hand before entering any trade. Till next time, every single one of you out there, trade safe.